One of the advantages of a free mind in a free country is you can do a lot of things and not get in trouble. And the advantages of this replay system is you can try your ideas out and it doesn't cost you anything. And some of the ideas that people have, they'll pick up from books, or they'll, talk to their brother, cousin, or whoever and say, hey, that sounds pretty good. And usually the other person is quite convinced that this is fantastic. I'm not quite the same. I have a engineering mindset about software and math. Uh, I like to know that something actually works. So I'm rather relentless in testing stuff out. If it's a good idea, I'll look at it, and if it looks like it's worth testing, I'll test it. So I have read about 250 books on trading, and they were technical trading. Some of it was investing, and I tested just about every book that had an idea that was mathematical in nature. Some books are just conversation and say, hey, you probably should try this. And there's a few books that actually review statistics. One of them is What Works on Wall Street, and by O'Shaughnessy, and he talks about what things work and what doesn't. And most of the stuff he says is a bit better than average, but not fantastic. Albert Einstein in 1930s worked with a great mathematician named Bose, and they thought that they could solve the stock market and predict it quite nicely. And he came up with an indicator which is based on Brownian motion. You can look all that up, but the reality is that he took a formula for one thing and applied it to the stock market, and it was not the right tool for the job. Brownian motion is based on randomness. The stock market is not random. It is based on people and their beliefs and emotions. That's what drives the market, is belief. The belief that the stock will go up in value, or the belief that the stock will go down in value, and people put money to push it. So it's not like a pure mathematical system. It has emotional realities, and that's what causes it to move up and down. So you can develop your own system. You need a few things if you're going to develop a system, and let's talk about that. And it doesn't matter if it's forex trading, commodities, stock market investing, or day trading or swing trading. You need to have a few parts to your system, and it doesn't matter what indicators. If the indicators work, that's all you need. But let's talk about the components of a system. I'm going to presume you're a trend trader, but you can make money in large, tall cycles. But let's go with trend trader. So you need a signal for high probability. You need a junk filter to help you stay out of things that a signal might tell you to get into. You need both. It's two perspectives. And then finally, you want to test this thing to make sure it works over multiple years, because if you think it works because you've tested it over a 1 week or 2 week period, I've seen lots of systems that fail because in some other time period it doesn't work, and they've put money on the line and they've lost it. So let's start out with signal ideas. The most commonly used signal system is based on 1 or 2 or 3 or 4 moving averages. A moving average is basically the sum of a number of prices added up over a certain number of periods and then divided by that, so that you get the average price in a period of time. And so there's a 20 period, 200 period. Basically the price is divided over those 20 periods, and that point is drawn on the chart. Here I've got 4 moving averages drawn on the chart. And at first, it looks like it's great. On the left side of this chart, it's looking fantastic. It was a great signal. And how the signal system works is essentially you have, when one line crosses the other line, you get in. And there are books written on that where people have done statistical studies, and they found that, yes, it works when the market is trending, but when it is sideways, which it is 75% of the time, roughly, sometimes 60% of the time, but something like that, the majority of the time, all markets are sideways if you look at the bigger picture. So that means the majority of the time, the signal is wanting you to get in and make a trade and put money down. And then you find out that you're on the wrong side of it when it's too late and you're already in a losing position, and then it crosses over to the other side. And all of a sudden, you're losing money. So here is another stock. These are just any particular day will do, but you can see how bad it is. And I'm going to reduce the number of lines so that you can see what it looks like with just 2 lines as a crossover. I'm going to just get rid of that one, and we'll get rid of that one. And so we're looking for when this line, so right there it crosses over, we should be going down. Generally this stuff, and you will have a chance to add that up if you want, it generally loses money. It only makes money when it runs long enough, which for most stocks most of the time doesn't happen. Even in this one where it moved up really well in the beginning, it moved up, then you get the crossover here, so you'd be told basically to sell here. You would have lost all the profit from up here to down there. You wouldn't have been able to take that profit if you just used that signal system. This is part of the research, and it's not just me. There's lots of great books and lots of statisticians, and they'll tell you that a crossover system of moving averages doesn't work, which, by the way, is the basis of the MACD. Mostly in my research, it hasn't worked. It's too slow on top of that. It uses too many candles. But there's lots of people that say the MACD is awesome. Well, there's room for improvement in all fields of science and math and everything. There's room for improvement over the MACD and moving average crossovers. I'm just going to show you a couple of them that are built into this program. Here it was saying that was the time to get in, but it lost color somewhere during the drawing of this bar, not down here, that it was time to leave. And here it said, well, you know, you should go red, and maybe you should look at going green. But the most important thing, more important than a signal, is the junk filter. Because remember, the market is not just a mathematical system, it's driven by people. Otherwise, Einstein would have been a billionaire with his math formulas. You need a junk filter, and that means, especially for trend traders, you need something that is a breakout system. So you're looking for, in this case, this is a wave box, it's based on half hours, that you're looking for something to break above this line, and then it would be interesting to trade it for that half hour. Or in this case, if it breaks below this area, then you'd want to trade it that way for that half hour. That's where you're mixing an alert with a filter. And there's lots of filters. You have to pick the ones that you like. I like a few rules that are based on what people do. So one of the indicators that we have is called target prices. And what does that look like? I'm going to turn off the wave boxes. It says that when the price gets to around here, it's probably going to turn around. And it'll have trouble beating it. It may get up there, but then it'll have problems beating it. And this happens a lot. That's because this indicator is based on people. There's a lot of floor traders that use these numbers, and some of these numbers are not published. And they're using these formulas. These are the professionals. They're using numbers like that to say, I'm going to sell because I know the other people that have big money are also selling in that point, so I'm going to get out. Let's look at that other stock again. It just bounced around, but you'll notice that it came down to this pivot price a few times, and it didn't go below it. If I look at all kinds of stocks, you'll find that it quite often bounces between these prices, these target prices. What's amazing about these prices, see here, is that these are calculated before the day begins. Once the day opens on the market, these numbers are known to these other professionals, and they've been using these formulas for decades. That's why they're reliable. And like I said, some of these formulas are not published to the general public, but some of them are. And so some people use them and some don't. And you'll notice it happens again and again. Where it comes to that price, there's resistance. There's somebody out there selling the stock. And then it finally breaks it. And then comes up and hits another one of these. And we've got years of data we can look at, and it's working for years. It's an amazing indicator. And that's the power of a good indicator. You'll see how it struggled in this price and this price. We can look at this again and again, and you'll see how often it happens. Now, this is a dead stock. That's again where a junk filter comes into play. So here's one of my favorite junk filters. It's called the risk zone. Basically, I'm looking for a breakout. Remember, we're trend traders. If it's just going to go sideways all day, I'll lose money. I won't even make money. I will lose money. That's just the nature of options. However, if it breaks out like that first one, it broke out of the risk zone right there on the first candles. And then it ran up, and then it came down into the risk zone, and then it finished. But I have a rule. Remember, this is not just math, it's human behavior. Is if something hits one of these target prices, then it's probably time to look at getting out if it shows too much weakness. So that's a rule, not just math. If we look at some other random stocks, how about this one? It broke out of the risk zone. It stayed outside of the risk zone. If I wanted to, I could have hung on to it. So this is with the moving average genius line, which is a moving average, but it's a bit smarter. It tells me about slope. I don't care about crossovers. That's too slow. I want to know about the slope in here, that it's actually eased off, that it's not moving very well. That's more useful. It's more pertinent. So what other indicators are there out there? There's also the K-band, which is better than Keltner. These Keltners are actually better than the average Keltner, but they're essentially telling you that it's a trend. You still need a filter on there because, as you can see, it came back into here and it looked like maybe I should be going in the downward direction. But that's another one of the rules of logic. That's what the summary of rules says, is I should not be trading on the red side when the stock has already been showing a lot of green today. Usually you're just getting a little bit of a retracement, a small pullback. That's riskier than staying with the green side or just going to the sidelines and finding something else that's a strong indicator of what's going on. So these little reversals are not worth your time and money. Well, they're not worth my time and money to get into. They're too much of a risk. So when I'm above the opening price of the stock, which in this case was down here today, I will only be trading to the green side. I have at least a 5% advantage in profit by doing that. Building a trading system is a lot of work. It's way easier to go to Costco and buy a tire than it is to just build your own. And trading systems are much like that. I spent years at it. Albert Einstein finally gave up on his trading system and went on to do other useful things with his time. If I could have found a trading system that worked consistently and 80+% of the time, I would have used that instead of wasting years developing my own trading rules. You get the benefit of my years of education in trading in this course. It should save you years of time and make you much more successful in weeks. And I wish I would have met me years ago and saved myself a ton of time. Anyways, this is why Scott wanted you to have all this information, and he encouraged me to produce this course so that your trading success would happen way faster. Thank you for watching.